In the previous class, we have seen the accounting of depreciation, where the depreciation could have been directly adjusted in the assets account. Depreciation is adjusted in the asset account, and then the depreciation is transferred to the P&L account. This is one model. In the another model, depreciation is not adjusted in the asset, but it is going to be accumulated in a new account called provision for depreciation account. Is that okay? And then the depreciation should be debited to P&L account. So these are the two differences. In these two cases also we have seen in the previous class, depreciation is debited in the P&L account in the first option year after year. That amount is subtracted from the assets value from the balance sheet, so the asset value will be decreasing year after year. Under provision for depreciation model, again the depreciation is as usual debited to the P&L account, but we are not going to subtract that from the asset. Rather than subtracting it from the assets, we have accumulated in the provision for depreciation in the either liability side or it may be in the asset side itself by subtracting from the value. Okay, so 15. Second year, the provision for depreciation is nothing but the provision for depreciation for the first period and second period both put together will be the value. Third year is also being the cumulative value and the last year is also cumulative value. This is one way of showing. The another way of showing is, so we are going to subtract the provision for depreciation from the balance sheet assets value. Find out the difference between these two models. Here, the depreciation is going to be adjusted from the original value of the assets year after year. You will write the assets value at the WDV. From there, years on depreciation is going to be subtracted. But under the provision model, the assets value will continue to appear at its own original value. From there, I am going to subtract the accumulated depreciation or aggregate of all the years depreciation. 15. Second year, the depreciation up to 2 years will be subtracted here. So you have to understand the difference between these two models. In this scenario, already we have discussed by the end of fourth year, we are aware about the value of the assets. By the fourth year, the value of assets being 5 rupees only, because year after year we have subtracted 15,000 rupees. In a matter of 4 years, we might have subtracted 60,000 rupees. Now it appears at rupees 5,000 only. On sales, the entry being bank account debit to asset. Asset should be always recorded at its own book value, because the asset what appears in the balance sheet will not be appearing hereafter. As it is going to be removed from the balance sheet, how it is possible? It can be removable only by reversing it with the same value, with the same number. 5 should be reversed. The asset side represents debit side. To reverse that, I have to credit it. Very simple. And that too, this number is 5 in the debit side. To eliminate that, so I have to credit the 5. But by selling, I get 10,000, not the same 5,000 rupees. Whenever I get something different than the amount to be supposed to receive for the assets, that will be either named as profits and losses. Here the bank account debit being 10,000 rupees to assets 5,000, the difference between these two is your profit can be credited here. This is the easiest way of solving the illustration. If the asset is sold in loss, then bank account debit, the loss should be debited, so loss on sale account debit to assets. That's how we can pass the exam, journal entry. Now sometimes these entry, this particular entry may be modified. We pass the entry through asset disposal account. We supposed to dispose one of the assets, then that asset will be transferable to the new account called asset disposal account. Now understand, I am using the transfer entry. How many types of entries we have? Just think over. We have opening journal entries, adjustment entries, rectification of errors entry, and closing entries. Here it's all about transfer entry. So in transfer entry, I am transferring from one item to the another item. I am transferring from one to the another one. Is that clear? That's the logic you have to understand. Bank account debit to profit and loss account credit as there is a profit and to asset. Now, I am transferring the asset to the asset disposal account and then I am going to sell it off. I am going to sell it off. Now, asset is being in debit side. On transferring this asset from asset account to asset disposal account, I am eliminating the value in the asset. How it is possible? I have to credit this to eliminate. As it is transferred from one account to the another account, if I am crediting this account, it goes to the another account, that account should be debited. That account should be debited. Is that clear? Is that clear? Now, what's the journal entry here? I have to debit the asset disposal account, debit to asset account. So, first of all, you have to pass this entry. I am not selling the asset as it is. On sale of the asset, the entry being bank account debit to asset. But here I am not going to sell as it is. Right? Here the asset is transferred to a new account called asset disposal, and then now that asset disposal is going to be closed. The asset disposal account could be either assumed to be real account or nominal account, whatever it may be. It's your logic. Okay. Why do I call this being the nominal account? Because I already planned that asset supposed to be disposed as soon as possible. So it will not be for more than 1 year. So it may be considered as nominal account. Okay. Or you can consider this being a real account. There will not be big harm for that. So now we have created a new account called asset disposal account. Now I am going to close that account. How do I close? Selling it off for 10,000 rupees. So for that the entry being bank account debit, 10,000 rupees. How much I am getting? 10,000 rupees I am getting because it is sold for 10,000 rupees. And the value of the asset disposed here being 5,000 rupees as per the books. So it is available in asset disposal account. It's not available in the asset account, asset disposal account. 5,000 rupees. The difference between these two is nothing but what? My profit. So profit on sale, profit on disposal. So if you club or combine these two journal entries, you will be getting this entry, right? This is the method you have to follow, where asset is disposed through a new account called asset disposal account. Asset disposal account. Is that clear? And in the second model, same illustration, already guided you that in this illustration, the depreciation is accumulated in the provision for depreciation account. By the time the balance sheet will look this way, asset will appear in the asset side at the book value ₹65. Provision for depreciation appears in the balance sheet, either in the liability side or it might have been subtracted from the asset side in the same asset side, which is the accumulated depreciation as in the date of sale. Fourth year after, the accumulated depreciation of the asset being 60, supposed to be saleable for 10,000 rupees assets. Now, the original value of the asset being 65. Usually, if I want to sell the asset where depreciation is routed through the provision for depreciation model, there the entry being provision for depreciation account debit and two assets to if there is any profit or loss and bank account debit. That's how we passed in the previous illustration. And when it comes for asset disposal account, what we do is very simple. This provision for depreciation and asset both will be transferable to the asset disposal account. Because the sale of assets after some times of usage should be routed through a new account called asset disposal account. Whenever I tell you, you have to transfer from one account to another account, suddenly the thing that should be in your mind is, whatever the existing balance where it is should be cancelled and where it should go should be charged for. So then the provision for depreciation is the credit balance and the asset is the debit balance. Is that okay? Now to cancel the asset, it should be credited. To cancel the provision for depreciation, it should be debited. Now the ultimate value will go to the asset disposal account. Now let me pass the entry for this one first of all. Asset value is transferred to the asset disposal. The entry being, yeah, come on. Asset disposal account debit. Yes, indeed. Asset disposal account debit to asset account. How much is that? 65, 65. Entry number 1. Entry number 2 is for transferring the provision for depreciation to asset disposal account. The entry for this being provision for depreciation account debit, provision for depreciation account debit to asset disposal account. The value being 60. The value being 60. Is that okay? Now, think over here. What is the ultimate balance in the asset disposal now? The ultimate balance in asset disposal being 65 minus 60, only 5 rupees. Now, I am going to sell off the asset disposal or closing the disposal by selling. What is the amount I will be recovering by selling this asset? 10,000 rupees. 10,000 rupees. But today, the asset disposal account will have a balance of 5. But sold for 10. So, I am getting more than its real book value. It's a gain for me. So, third one being bank account debit. Bank account debit. And the bank account value being 10. I am getting 10 rupees to asset disposal. To asset disposal. The value being 5. How do I get the 5 rupees? The value of 5 in asset disposal account is nothing but netting off the assets disposal account, where asset is also transferred to the asset disposal at the original value, and provision for depreciation, which is nothing but accumulated depreciation. Sometimes the provision for depreciation may be named as asset disposal, means accumulated depreciation. That should also be transferable to the asset disposal account. If you tally this, you will have a balance of 5. This 5 rupees worth asset disposal account is now closed for 10,000 rupees. The worth is 5, but sold for 10 means we are enjoying the benefit by 5 rupees. That benefit will be now credited to the profit and loss account. So, profit on sale, profit on either disposal or sale. And if you are getting less than the worth of 5,000 rupees, then it's a loss. That loss can be now charged to the profit and loss account. Now you will understand. You can directly pass the journal entry for sale, or it may be passed through or routed through asset disposable account. So we have 4 models type. What is the first model? Directly charging the depreciation to the asset is one of the models. Charging the assets means accumulating the depreciation, the provision for depreciation is the next model. Apart from that, we have the sale of the assets in later period. While selling, it's a very basic sale in the first model, the basic sale in the second model. So we have seen that. Apart from that, in the case of selling the asset routed through the asset disposal, the first model also we have the asset disposal, and second is also we have asset disposal, right? So these are the concepts you have to keep in your mind. Clear? Now, in the previous class, I briefed accounting of depreciation. Here, we have 2 methods. First method is all about what? So, method of depreciation is talking about SLM and WDV method. So, accounting of depreciation means it's accounting treatment, passing the journal entry. Here, first one is charging the depreciation to the asset. Second one is accumulating the depreciation, the provision for depreciation model. And when it comes to the sale of the asset, we have what? With the basic, directly selling the asset. Another one is routed through asset disposal account, right? Direct sale. Another one is routed through asset disposal. So we have now completed the asset disposal model. Is that okay? Come on, make a note of it.